Okay, it's 7:01, so I'm going to go ahead and get started. Brian, I can see your picture there. Give me a thumbs up if I got good audio. Okay, I didn't get a thumbs up.
I can hear you fine.
You can hear me fine?
We can hear you.
Okay,
yeah, you're good.
Thank you. I appreciate it. Okay, good news, maybe for some of you. Tonight represents the last of our testable material. So after I get through module 12 tonight, we will have covered everything that you are going to be held accountable for as insofar as the exams are concerned. So the third exam in this course will cover modules 9, 10, 11, and 12. I'm going to lecture on module 12 tonight, and then we will be done. And the last 3 weeks of the semester are entirely devoted to just getting that semester-long research project in. So that's by design. I know most of you, probably haven't really gotten after it yet, and that's normal. So if you're feeling a little bit of overwhelm, that's normal too. But the course is laid out that way for a reason, and you're going to have time to get that done and get that in. And we're going to turn the next time we meet, it's going to be 100% workshop, and there's still a lot of points available in the class for anybody who might have been disappointed by those second exam scores. So the last time we met, I was lecturing over module 10 and the exam was still open, so I didn't have visibility into the final scores. I do have visibility into the final scores now, and the grades were a little bit lower than they are normally. So I'm dealing with a new version of the text this semester. So this is, I think this is, well, here it is, version 6E. So I had been testing over version, 5E, and well, after I test from a book a couple of times, I learned which questions are good and which questions are bad, and I think there were some in there that, well, they weren't great. They're multiple choice questions, right? So sometimes the authors feel like they have to intentionally word those a little tricky, and they do, and they try to test your knowledge. But because the scores were a little low, I'm gonna apply a curve. It looks like it'll probably be between 5 and 10 points, but again, I'm gonna go back and look to see who had all of their exam homework in, because I don't, like we covered in the beginning of class, I don't think it's fair to award points to someone who comes to class or comes to the exam unprepared. So with the caveat that assuming you had all your homework in when you took the exam, there's probably going to be a little curve available for you. But even if there's not, there are a ton of points left in this class, because about half of them are yet to come. We have the semester-long research project, which is 300. You got the presentation, which is 50. We got 4 more homeworks, which is 40. We got another exam, which is 150. So if you're feeling like you're struggling or you don't have the grade you want, there's plenty of time to buckle down and get the grade you want and absolutely pass the course. After I lecture tonight, I'm going to open the third exam. It'll be open for a long time, because next week's Thanksgiving, and then we come back, and well, I know you guys always like to know exactly when it's going to be open and closed, so I'll get it posted sometime this week. So let's say I get it posted tomorrow or the next day. Then you got Thanksgiving week. Then we come back and we'll do module 14. So I'll probably leave it open through the 7th. So maybe like almost not quite 3 weeks. So you'll have all of Thanksgiving break, but I don't want you to stress out about the exam over Thanksgiving break. So I'll leave it open the week after that too. Plenty of time to take this. Don't put it off, but plenty of time to take it. And when I post it, I'll put the open and close dates up there again as another little reminder about how all that's going to work. And I think that was it for my housekeeping issues. Let me pause there, take any questions that you all have about the course, the research project, the homework, anything before I just jump into a lecture tonight. What's on your mind?
I have two questions actually.
Yes.
Yeah, for the first one for the exam number 3 is going to be 2 hours. We're going to be less, more,
yes,
little bit.
Same as the first two.
Okay. And the second question is for the research. I tried to pull up the from Thomas One research, and I see almost like the maximum pages that I have seen is 22 pages, and you said you have to get at least between like 50 to 70. So I tried to maximize my pages, but in fact, actually, I couldn't. I mean, is there any other way that you recommend us to do? Or I don't want to just throw some words just to maximize my pages. You know, that's my concern actually.
Well, my experience has been that when you go to lay this report out, like we have seen, so if you go to Canvas and you download one of those other pages, which one do I want here? There we go. Okay, bear with me here. So we have okay. Let's look at Qualcomm here. So if you look at this report, you're going to notice that the report is, well, maybe, I don't know how long it is, 50 to 70 pages. But when you okay, 70. So when you compare it to what you're downloading from Thompson One, the only relevant comparable is the executive summary. So as you scroll down through this report, you're going to see that the author here covered the 4 M's: management, moat, mispricing, and mark. And they did that very concisively in the executive summary. So you have the front page, and then you have, I don't know, 12 or 14 pages covering each of the 4 M's with some detail. And I want you to take note about how they did that, because I want you to structure your report the same way. And then, okay, here it is. So there's only, well, a little bit more, bear with me.
I can't see your screen.
Oh, okay, thank you for telling me that. Let me go new share here, screen 2, share. Now, can you see my screen?
Yes.
Okay, so I'm looking at this Qualcomm report, and this report is really only 15 pages long. Management, moat, mispricing, and mark, very concisely detailed in the executive summary. And then what you're going to notice here is that everything beyond the first 15 pages is an appendix. And the appendix goes into great detail on each of the modules that we've covered in this semester thus far. But most of this material won't be in the reports you're downloading from Thompson One. And it's not in there because it's largely reference material. You know, those analysts don't cover like the discounted cash flow analysis here or some of the other material in the appendix. This is all structured. You can see there's one module, there's one section of the appendix for every module, and then it's just a matter of whether or not that section of the appendix pertains to your particular company. So I think a couple weeks ago, we talked about the accounting for leases, and I expect that to be covered in your appendix. Now, if you're doing a company like, I don't know, Apple, they may not have any leases, and you can just say, that's not applicable for this company. But make sure you say that in the appendix so that I, as the grader of these, know that you've gone through the effort to make sure that it's not applicable and immaterial to the company that you're analyzing. Conversely, if you're working on Southwest Airlines, that section of your appendix is probably going to be very lengthy. And then you'll have to come to some determination about whether or not it's so material in nature that you would want to promote it up to the executive summary and talk about why or why not it's meaningful to the valuation of the company. So does that help clear that up a little bit?
Yes, yes, absolutely, yes.
Hey, Professor Vern.
Yes, sir.
Hey, we talked the other day on the phone, Matt over here.
Oh, hey, man.
Yeah. So I haven't started the paper, as you just said, but I did evaluate. Wouldn't you say the best way to go about this is to start with the appendix? It looks like the appendix is what writes your body, and the body does the executive paper. Like the
You're not too far off. What at the start of the semester, I kind of tell everybody to just kind of keep files as we go through the course. And that's kind of exactly what you just said there. You kind of write your appendix as you go, and then every week you learn a little bit more about your company. And by the time you get to the end of the semester, you're better prepared to write the executive summary. Now, if you're a procrastinator like myself, you get to this point in the semester and you're wanting to know, okay, how do I fast track this? And the best way to fast track it is to download the Morningstar research report, because those guys do good work and they're going to give you most of the hard-hitting points are going to be prepackaged for you. Then go to the investor relations website and get to work on the appendix, and it'll all, I think you'll find it'll all come together more easily than it looks like when you got to.
Yeah, it looks like you just got to find the information and it'll put itself together for you.
It's not as daunting as it looks. That's true.
All right, thanks, man.
Yeah. Other questions?
Professor Byrne, another question for you on the paper.
Yeah.
So I guess I apologize if this is covered in in a rubric somewhere, but in terms of modules that need to be covered in the appendix, are we going up through module 12 that we're tested on, or do we need to go past that for the paper?
No, you really only have to go to module 10.
Okay.
Because once you get to module 10, we're through the accounting. Module 11, which was an online lecture last week, was the forecasting methodology. And from 11 onward, we're into valuation techniques. So this class is financial statement analysis and valuation. So now we're into the end valuation part of this class. So the first 10 weeks, heavy accounting. We go deep into the accounting. We need to be able to position ourselves to know the difference between material and immaterial as it relates to our companies. Then we're going to take all that information. We're going to make whatever adjustments that we need to make, and then we're going to forecast that information into the future. That was last week. Tonight, we're going to talk about some valuation techniques that work with that forecasted financial statement, multiple statements, and help us to put a value on it. What is this company worth? What is the debt worth? What is the equity worth? What is the price per share that we think is fair? And there's several different ways of doing that, and that's really what the rest of the semester is about. So you really just need the first 10 modules in the appendix, and then a single section of your report for valuation, and that's in the executive summary. So that would be the mispricing is a synonym for the valuation.
Thank you.
Yeah.
I just have one other logistical question too.
Yeah.
On grading. You mentioned the potential curve and whatnot. Right now, I know a lot of our grades for homework and exams, just live in the My Business Course website and not necessarily on Canvas? If and when that curve shows up, will it show up on My Business Course or on Canvas?
I don't know.
Okay.
Probably neither. I'll decide what the curve is, and then I'll just say everybody gets this many points, and then you'll be responsible for saying, oh yeah, I get an extra 5 points. And then I'm going to put it in an Excel spreadsheet that I use at the end of the semester to tally up everybody's scores.
All right. Appreciate the
It's pretty low. It's pretty low tech, but it's gotten me through 5 years so far. Yeah, if I get a wild hair and want to integrate those two things, I'll let you know.
Okay. Are we able to see our grade in My Business Course?
You should be able to, yeah. So take a look, and if you can't find it, let me know. Okay, I am going to jump into Module 12 then, not hearing any more questions. Okay, tonight we're going to talk about cost of capital and valuation basics. And then Module 13, 14, and 15, we'll dive a little bit deeper. So for any of you that have taken, oh, who's teaching investments now? It's not Dr. Mock anymore.
Kuipers.
Kuipers. Okay, so if you've taken Kuipers' investment class, then you've probably done a discounted cash flow analysis. And we're going to be talking about the very beginnings of that in Module 12. So this will be review for you. That's terrific. And next week, we'll go a little bit deeper into that discounted cash flow analysis. For most of you, Morningstar's already done this. So you'll be able to download their discounted cash flow analysis and use that as a jumping off point. And I encourage you to do that. Don't plagiarize their discounted cash flow model, but download it, gain a familiarity with it, and then adjust it to match your level of thinking based on all of the work that you've done over the last 16 weeks. Now, I say don't plagiarize, but if you agree with their work, then your discounted cash flow model is going to look very, very similar, and that's okay. You just have to make sure that you correctly cite that, give them credit for what they've done, draw any distinctions between your opinions and their opinions, because hopefully you will have a differing of opinions somewhere, and that's really what the art of valuation is all about. So let's begin here. Module 12 is not very lengthy. It's going to take me probably about an hour to lecture on it tonight. So we have extra time. I think from this point on out in the semester, we're going to have a lot of extra time to focus on the research report, which is good.
Sorry to interrupt. Is there an updated information to get into the Morningstar, the login? The login I used before, the password doesn't work.
Oh, not that anybody told me.
I didn't have any trouble getting it with the information you have
Okay.
on the Canvas, so you probably ought to double check it.
Yeah, I'll just double check. Okay, sorry about that. Thanks.
No problem. Well, I just logged in, so it's the same. So I just use those credentials to log in. You should be able to get in there too. So give it another try. All righty. Okay, high level. When we talk about valuation, what are we trying to do? Well, there's several things that we can use the beginnings of a valuation methodology. We can compare that against the trading price of a stock, which is what we're doing in this class. Financial statement analysis and valuation all comes down to how do we put a stock price, how do we put a valuation on a stock? And then do we want to buy it? Do we want to sell it? Can we put that to work? And that's where Kuipers' class really comes in, because when you do that professionally for a living, you're probably going to have some coverage universe, and it's going to be your job to assess the value of 50 to 100 different stocks. You're gonna know them like the back of your hand, and then from those to create a diversified portfolio. And if you can do that with with skill, you can be very, very well paid to manage portfolios on behalf of investors. Other places that you see this skill set coming in is in initial public offerings, determining a price for a bond or other financial instrument, because the analysis work is all the same. The theory of it is, if we knew with certainty what the future cash flows of a business were going to be, well, then we could also know with certainty what that business was worth. And that's how the bond market works, especially when we start talking about the bond market for treasuries, which are guaranteed, and we don't have any element of credit risk. So when we know with certainty what the future cash flows are going to be, there's no uncertainty about what something is worth today. It's a little bit more complicated when you get to talking about stocks. That's where module 11 came in. We talk a lot about forecasting. How do you begin to forecast the future? Well, first place you look is at comps. So Adam just asked a question here. He's like, do you like DCF or comps? And that's a great question. I think as we get a little further into the module tonight, you'll see that the answer to that question is both. And module 13 talks about DCF, module 14 talks about comps. When I say comps, I mean comparables, comparable companies. So Ford and GM ought to be valued similarly. If you look at a simple valuation technique like a price to equity, and Ford has a price to equity of, let's just hypothetically say 15. Well, GM should probably be in that neighborhood too. Certainly shouldn't be 30 or 40, shouldn't be valued like a tech stock or a high flyer or a high growth company, because it's just not. The industry can't support differing valuations for companies that are so similar. So to look at the comparable valuations of comparable companies is always going to be of relevance to whatever we're doing work on. And I encourage everybody in this class to include it in your valuation, and then also to include it in any future work that you do on valuation as it's a smell test. It's going to tell you if you've done anything wrong in a discounted cash flow. So the two go hand in hand. It's a great question. Like I said, what we're really looking at here are the payoffs or the cash flows. So if we know those with certainty, we're going to be able to value the instrument that we're looking at. The bondholder is looking at the interest payments and the principal payments. We looked at that, I think it was in module 5. When we look at valuing a stock, what are the cash flow payments that we have to deal with? Well, tonight we're going to be looking at dividends. Next week, we're going to be looking at cash flows to the company. And the primary difference is that dividends are distributed. So we as shareholders get the cash dividend checks, but we still actually own the business. And if the company's management team chooses not to distribute those earnings, but to reinvest those earnings, well, then we would use a different valuation model. And that valuation model is called the discounted cash flow. We're going to start with dividends. It's a little easier to understand. The basic framework of each is the same and should be a good jumping off for us into the valuation. Module, slide number 5 here shows the whole semester in review. If you recall, we looked at this same slide in our first class in module 1, and it really set up the whole semester. So you can see here that in modules 1 and 2, we spent that night understanding the business environment and accounting information. So that takes us all the way back to things like the Porter's 5 forces and the SWOT analysis and so on and so forth. And then for the bulk of the semester, we went heavy into the accounting. That took us from 2 all the way up to module 10. And those are your appendices, just like I mentioned a moment ago. Last week, we talked about forecasting. That was module 11. And then 12, 13, 14, 15, all valuation. So that's what we're going to be talking about for the rest of the semester. How do we take all this information that we've been crunching for the last 10 weeks and translate it into a forecast that we can have some confidence in, and then discount those cash flows back to time 0 using the time value of money concepts that we've studied in probably several classes now to figure out what something's really worth. And hopefully that slide makes a lot more sense today in week 12 than it did in week 1 when we first looked at it, as this all comes together. Okay, I mentioned everything on this slide with the exception of this last bullet point. Valuations models differ, just like Adam asked a moment ago, about the difference between comp models and discounted cash flow models. We, as the analysts, need to understand the pros and cons of the different models that we might be using. We need to understand where the cash flows come from. We need to understand the shortcomings of each of these models. So I mentioned we're going to be starting with a dividend discount model. What happens if a company doesn't pay dividends? Some models are more appropriate for high growth companies. Some models are more appropriate for low growth, stable value, like utility type companies. You need to know what you're dealing with, and you need to know the pros and cons of each model. Okay, so let's begin with a definition of intrinsic value. Intrinsic is the true worth of the firm. So the intrinsic value of a firm equals the intrinsic value of the debt plus the intrinsic value of the equity. This ought to look very much like the basic accounting equation. So if you substitute intrinsic value for assets equals liabilities or debt plus equity. And in this case, we're solving for the intrinsic value of the firm, which you might think of as the intrinsic value of the assets. And a lot of times you'll hear analysts call this replacement cost. So hypothetically, if we went out and bought identical versions of the same machinery, the same factories, the same distribution fleet, the same software, the same employee base, if we just replicated all that and went out and bought it, would we have the same asset base, and therefore would we have another identical firm? That's called a replacement cost. And it's another valuation technique that's meaningful. And for some firms, that's exactly what they're worth, the replacement cost of their assets. Now, for other firms, take Apple. Apple is a great example of this. Well, hypothetically, if you had the money, you could go out and duplicate all their factories, but you're never going to produce a firm that's as valuable as Apple, because Apple has enormous goodwill and enormous intangible value in that brand name recognition. So you would fall far short of recreating the value of what they've actually been able to do. Okay. Okay. Time value of money. Gosh, I hope this is a review at this point in your careers. This is one of the few formulas that everybody should have memorized coming out of an undergrad or even a grad program. The present value is the lump sum of its future payoffs. And let's talk about that basic equation here. So in this instance, we're looking at a bond note. It involves the time value of money. So here we have the interest earned. We're going all the way back to module 5 here again. This should all be review. We get $90 in interest in period 1, $90 in interest in period 2, and $90 in interest in period 3. Also in period 3, we get our principal repayment of $1,000. If we discount each of those cash flows back to time 0 and add them up, we're going to get a present value of $975.13. We can do the exact same thing with dividends, and we're going to look at that here in a moment. Let's assume that a stock pays a constant dividend of $90 per year for 3 years. And then it's sold for a lump sum of $1,000, or a terminal dividend at the end of 3 years. Okay, that's exactly what we just looked at with the bond. Let me go back a page. If I go back to slide 9, you can see that this bond paid dividends of $90 in the first 3 years and then principal of $1,000 in the third year. Well, note how the authors set the exact same cash flows up in this example here. They say, assume now it's not a bond, but assume it's a stock. And assume the stock pays $90 in dividends for the first 3 years. And then at the end of that period, it's sold for $1,000. See how the exact same valuation technique can be applied to either stocks or bonds? So here again, if we know the future cash flows with certainty, we know the value of that stock or bond. So the most important component of your valuation is in the forecasting of those cash flows, which is module 11. Module 12, 13, 14, and 15, really just different valuation techniques. We're going to apply several of them to the companies that you're working on and kind of triangulate in on a valuation that we're most comfortable with, but it all hinges on the forecast of those cash flows. And that's really where, well, that's the key skill set of the analyst. If you can get that right, then the number crunching that comes from here on out in the semester is not that difficult and not that challenging. And as a matter of fact, it's something that you can plug into a spreadsheet and you won't have to revisit it very often. It's that forecast that's the really tricky part. Okay, now the only difference between those two examples of discounting a stock and discounting a bond has to do with the discount rate. Now the discount rate for a bond is the cost of the debt. And we know the cost of the debt. It's usually printed on the coupon. In module 5, we talked quite a bit about what happens to the cost of that debt or the yield to maturity if a bond trades at a premium or a discount. So the yield to maturity can fluctuate a little bit, but for for an equity or for a stock, we're going to use something a little bit different. We're going to use something called the cost of equity capital. And then next week, we'll talk quite a little bit about a discounted cash flow analysis. And a discounted cash flow analysis is primarily concerned with cash flows to the firm. So not cash flows to equity holders or cash flows to debt holders, but cash flows that accrue to the firm before any interest is paid to debt holders and before any dividends are paid to equity holders. When you focus on cash flows to the firm, you apply a discount rate called a weighted average cost of capital. And that's exactly what it sounds like, which is an average of the cost of debt and the cost of equity. Let's look at that cost of capital here on slide 11. We're going to use the time value of money. We're going to add the foregone interest that investors do not receive when they choose to invest in stocks. And then we're going to add some level of compensation for bearing the risk associated with uncertain payoffs. So over here we have a risk-free rate. So investors always have alternatives. And one of those alternatives is that they don't have to take on any risk at all. And if they don't take on any risk at all, there's an interest rate out there for them. They could invest in the 10-year treasury. And let's just call that 1%. I think it's less than that today. I think it's about 70 basis points. But let's just call that 1%. But in order to put their money to work in the stock market, they're going to require something greater than 1%. They're going to require some level of compensation for the additional risk. And I'm going to show you how we calculate that here in a moment. These two components make up what we call the risk-adjusted discount rate. And that's, you'll hear our authors and other people in our industry call that the required rate of return, or the cost of capital. It's the required rate of return because that's what the investor requires to compensate them for the additional risk of investing in stocks. Okay, we need to understand a couple of concepts before we jump to the calculation of how investors typically quantify risk and calculate a required rate of return for assuming that risk. Two key terms are diversifiable and non-diversifiable risk. So because modern portfolio theory tells us that most investors hold investments in diversified portfolios, we're only going to compute the risk necessary or the risk required to entice an investor into a diversified portfolio, meaning that if we're inside of a market portfolio, if we hold a bunch of stocks, modern portfolio theory tells us that we can diversify away all of the stock specific risk. And because we can diversify away all of the stock specific risk, we only need to be concerned with the underlying stocks correlation to the broader portfolio. So diversifiable risk would be stock specific risk. Non-diversifiable risk would be market risk. Okay, let's take a closer look at that market risk. Okay, here's the formula. This formula is called CAPM, and it's it's probably the second formula that you need to have memorized coming out of business school. Time value of money, capital asset pricing model. The capital asset pricing model is the algebraic expression of what we just looked at here. We say that the required rate of return, or in this example, the authors are using the expected rate of return or the cost of equity capital, equals the risk-free rate, which is RE, the risk-free rate. Nope, wait a minute. I haven't looked at this closely at this slide before. Our authors got this wrong.
Yep.
RE stands for the cost of equity capital. So adjust this slide. RE is the return on equity capital. RF is the risk-free rate. So this arrow should come down here. Never noticed that was wrong before. So this should read RF equals the risk-free rate. That's why it's RF, commonly estimated with US Treasury notes. And that's usually the 10-year. So the 10-year rate plus B, that's beta. Beta equals the market's beta, or the sensitivity of the asset's return to the overall market, times this term right here. And this term is called the risk premium. And the risk premium is calculated as RM, or the return on the market, minus RF, or the risk-free rate. And RM, the return on the market, is usually around 9 or 10%. It depends on what you're defining the market as. For the purposes of this class, let's just note that most of the time it's defined as the return on the S&P 500. And if you go back 50 to 100 years, it fluctuates between 7 to 10%. The risk-free rate fluctuates between, well, 1 today, but usually about as high as 5. So that makes the risk premium typically between 4 and 8. You plug those values into that equation, excuse me, and you're going to solve for the required rate of return on equity associated with your stock. Now, let me give you a little bit of a heads up here. When you're working on your research project, this is all going to be given to you. You can look this up through Thomson Reuters. You can look this up through Morningstar. You can look this up through Bloomberg, and feel free to go ahead and use their cost of equity. Feel free to go ahead and use their estimate of your stock's beta Just note that in your evaluation section and then cite the source. You don't have to go through these calculations. For the purposes of the exam, you will have to know how to do this. Okay, gang. I need to take just a short break, and I'll be right back. Give me like 2 minutes. I'll be right back. Okay, I'm back. Sorry about that. I got into a patch of poison ivy last week, and I am just absolutely about to claw my skin off. So I had to grab some prescriptions there. Okay, where was it? I was talking about market beta and CAPM. When you think about CAPM, just kind of note some of the points that the authors give us here on slide 15. You want to note that what we're left with is called systemic risk, because we can diversify away all that company specific risk. What we cannot diversify away is called systemic risk. And that's where beta comes from. You know, to what degree does the stock you're looking at fluctuate with the market as a whole? Is it when the, and you can interpret that as if you have a beta of 1.5, then when the market goes up by 1%, your stock typically goes up by 1.5%. It's the degree to which it fluctuates with the overall market. Note that that is a statistical coefficient. I already mentioned that the market index was the S&P 500. It's usually calculated over 36 or 60 months. Yeah, I think we hit all those high points there. Let's look at one. Let's calculate one for NextEra. We can calculate the expected return for NextEra as follows. Expected return of 2.834% equals the risk-free rate. So here we're using the 10-year treasury rate is 2.034. Today that would be 0.7. So you can see that the required rate of return for equity would be quite lower today because we would be working with a treasury rate of 0.7. But for the purposes of this example, it's 2.034. And to that, we're going to add the risk premium. And the risk premium is this factor right here, where we have the beta. So NextEra has a beta of 0.16. That's very, very low. I don't know what kind of firm NextEra is, but you can probably guess. It's When the market goes up by 1%, this thing hardly moves. When it goes down by 1%, this thing hardly moves. So whatever this stock is, it's very, very boring. This would be like a piece of real estate or a utility, or probably very boring, very safe, not a lot of volatility, not a lot to get excited about there, which is just perfect for some investors. That's exactly what some investors look for, and I do business with a whole bunch of them. So there's definitely a market for a stock like this. And then the risk premium we assume is 5%. So you throw all those numbers into that equation there, and you're going to get 2.84. And that tells you that the average investor requires a rate of return of 2.8% to invest in NextEra's stock. So that's not very high. That means that the average investor is feeling like their money is pretty safe with NextEra. If it was more volatile, or if there were more risk to that business, investors would simply require a higher rate of return. If the business is riskier, you're going to see investors require more, which is going to result in a higher beta and a higher required rate of return. So know what the beta is for the company that you're doing your research report on, and be able to explain it. I'm tempted just to tell you not to worry about this slide, but I'm not going to skip it because it's my favorite slide in the whole semester. And I'll tell you why. Because we just looked at beta, which is a single factor model. It assumes that the required rate of return for any particular stock is based on one factor, the degree to which that stock fluctuates with the overall market, and we call that beta. Well, that's a pretty simple model, and models don't have to be that simple. They can get very, very complex. As a matter of fact, you can have more than one beta. You can have, these are called coefficients. You can have different coefficients for the degree to which your stock is affected by the overall market, or maybe the economic cycle, or maybe the overall aggregate level of GDP, or maybe you want to look at the volume of money or the velocity of money, or you can have as many factors as you can come up with, and you can statistically test each one of these to see if they're significant and meaningful. And this is some of the most advanced work that you see coming out of quant shops that are packed with MIT and Caltech grads. Some of this is on the forefront of just absolutely leading edge computer technology and investment trading. New algorithms that are driving markets around the globe. Maybe some of you in this class have read Michael Lewis's book called Flash Boys, and that's a great book. If you haven't read it, I recommend it, because it talks about how sophisticated some of these modeling techniques can get, especially around the measurements of momentum, because what scientists have been able to recognize is the herd mentality associated with stock market trading. So if you can recognize that herd mentality, and if you can recognize that money is moving into a certain name, a certain stock, well, you can front run that a little bit. And that signal became so powerful that hedge funds started to figure out they could earn rates of return by co-locating with the exchange. And what I mean by that is they would buy real estate next to the server farms of the NASDAQ and the NYSE and other large trading outfits, so that as this information came in, they could reroute orders nanoseconds faster than other traders who might be offsite in Chicago or Atlanta or Kansas City, for example. So just that millisecond information advantage worked into an equation like this proved through their trading model that it could consistently accrue profit over time. And it's just kind of the cutting edge of where our industry is at right now. So I think that slide is pretty fascinating. But we only get one slide on it in the whole semester, and that's it. So there might be one test question on that. If you wanna learn more, that would be probably Dr. Clark's derivatives class would be the closest to that. Certainly it'd be partially covered in Dr. Kuiper's investments class. Excuse me. The cost of debt, this is all review. We know that we're going to take the market rate on that debt, which is the yield to maturity, and then we're going to adjust it for tax consequences because we want the pre-tax borrowing rate equals 1 minus the tax rate, or if we multiply that times 1 minus the tax rate, we're going to get the after-tax cost of debt. So yeah, I'll review on this slide here again. We're going back to module 5. Everything that goes into credit ratings and debt capital, the lender's perception of how risky the debt is, looking at ratios like liquidity and financial stability, credit rating agencies. I'm not going to belabor any of this. Okay, let's look at a specific example. Here we're going to look at NextEra again, and we're going to calculate their cost of debt. Now we know that their cost of debt is 3.34, and we get to that by taking their pre-tax borrowing rate. This would be their yield to maturity. That's going to be disclosed in their financials, their pre-tax borrowing rate. Or you can simply take the amount of interest that they pay on their income statement and divide by the average amount of debt outstanding. That's another way to get their pre-tax borrowing rate. And we're going to multiply that times 1 minus the tax rate. In this instance, the tax rate is disclosed to us as 25.2%. We looked at the tax rate in module 10, and we also looked at the disclosures that are associated with that tax rate, always in the back of the 10K filing. So go find that table once again, and the marginal tax rate will be disclosed to you. Plug all those into our formula, and we come up with 3.34 as the after-tax cost of debt. Moving on to the weighted average cost of capital. So we looked at the cost of equity. We used beta to calculate what an investor's required rate of return would be on the equity capital. And that would be appropriate for a dividend discount model, because when we have dividends, we're dealing with cash flows to equity holders. And when we're dealing with cash flows to equity holders, we want to make sure we use a discount rate that's appropriate, which would be the required cost of equity. And that's derived from the capital asset pricing model using beta. When we're discounting cash flows associated with debt, we're going to use the after-tax cost of debt. Now we're going to take both of those two components that we just looked at, and we're going to use them to calculate our weighted average cost of capital. And the weighted average cost of capital is associated with cash flows to the firm. And cash flows to the firm are defined as those cash flows before any interest is paid out to debt holders, before any principal is paid out to debt holders, and before any dividends is paid out to equity holders. So those would be your free cash flows to the firm. And here's how you calculate your weighted average cost of debt. So the weighted average cost of capital, denoted here as RW, equals the return on your debt times the percentage of the firm that is comprised of debt, plus the return on your equity times the percentage of the firm that is comprised of equity. So if 50% of the firm is debt and 50% of the firm is equity, then these terms would cancel out, and it would just be your cost of debt plus your cost of equity. Let's look at an example for NextEra again. Our weighted average cost of capital, denoted as R sub W, equals our cost of debt, 3.34, times the intrinsic value of the debt divided by the intrinsic value of the firm. This tells us what percentage of the firm is comprised of debt. Oh gosh, got allergies tonight. I apologize. So we're going to take that term, and to that term, we're going to add the cost of equity. I did something wrong here. What did I do wrong? 42,000 interest-bearing debt is, so that is debt, and we're multiplying that times the cost of debt, so that's right. But 0.0334 is 3.334% as the cost of debt. And over here we have the cost of equity, which would be 2.8%. And that's off because your cost of equity can't be lower than your cost of debt, because the equity holder is always in a riskier position. The equity holder is always going to require a higher rate of return than the debt holder, because if you could earn a higher rate of return by assuming a senior position in the capital structure, which is inherently less risky, you would always take this. You would never take the more risky position and say, oh yeah, I'll not only take the riskier position, but I'll also agree to less money. Nobody would ever do that. So these numbers look screwy to me. I think we might have found another error in the text. Let's see. I just want to make sure I'm reading this right. We calculate the weighted average cost of capital of 3% for NextEra as follows. Cost of debt times the percentage of debt plus the cost of equity times the percentage of equity. Let's make sure those terms are right. The market value of the interest-bearing debt is 42,656. So those match. The market value of the equity is 83.115. So those terms match. We add the market value of debt and equity to determine the intrinsic value for the entire firm of, okay. So we just found another error. In this example, the cost of debt is less than the cost of equity, and that can't happen. So if this number over here were 5%, that would be more reasonable, because then the cost of equity would be greater than the cost of debt, and that's exactly what you should expect. So for the purposes of this lecture tonight, everything was put in here properly with regard to the way that the formula works. We just need to see this cost of equity number be greater than this cost of debt number, and then everything makes sense. So just make yourself a note in the margin there that when you're looking at your own companies and doing your own analysis work, make sure the cost of equity is greater than the cost of debt. Okay, now let's look at the dividend discount model. So we looked at the cost of equity, we looked at the cost of debt, we calculated the weighted average cost of capital, and now we're going to go through and look at the valuation models associated with differing costs of capital. So the first valuation model is the simplest. It's the dividend discount model. So here's our formula. The intrinsic value of the firm equals the dividend in period 1 plus the intrinsic value of the firm in period 1 divided by 1 plus the required return on equity. But that's an overly simplistic view because it only gives us one dividend, and then it assumes that we sell the stock at the end of the first period. And that's very rarely true. What's more often the case is that we hold the stock for a period of time. And when we do hold the stock for a period of time, that formula gets slightly more complicated. And you can see that down here, where we have the intrinsic value of the firm equals a series of dividends, D1 through 3 into perpetuity, perhaps, each individually discounted back to time 0 at the denominator there, 1 plus the required rate of return raised to the power of the nth period. Okay, algebraically, we can simplify this a little bit. And it looks something like this. We're assuming that the dividend persists into perpetuity. So if we make the assumption that that dividend is going to represent a stream of cash flows into perpetuity, well, we have an annuity. And we know from Finance 101 how to value an annuity, and we can plug that cash flow stream into that annuity formula, and it comes up looking, well, something like this term here. Okay, but I'm going to complicate it again. Neither one of those models that we've looked at yet are ever used in finance. Rather, what we use them for is to establish logically how we're moving from a simple model to a slightly more complex model to an even more complex model, which is presented here with what we call the dividend discount, or the, well, what do we call this? We call this the dividend discount model with increasing perpetuity. So this is the first time that you're going to see any growth associated with that underlying dividend. And this is called the Gordon growth model because Professor Gordon thought this up. And I forget his story, but he's got the model named after him. So the Gordon growth model algebraically is presented as the intrinsic value of the firm in time 0 equals the dividend in period 1 divided by the cost of equity minus the growth rate. So this assumes that that dividend is going to grow at a constant growth rate into perpetuity, and that would be consistent with, say, inflation. You know, say you have a dividend and the company's paying $1. That dividend's $1 per share. Well, next year and the year after that and the year after that, you would expect that to be a little bit bigger just as the company grows. So it might be reasonable to assume that that dividend is going to grow at a 3% rate into the future. And you see many companies that have successfully grown their dividends at mid-single digit rates for decades. So that would make the dividend discount model here, the Gordon growth model, an appropriate model for that company. And if you're looking at one of those companies this semester, McDonald's is a good example, ADP is another good example. There's a whole portfolio that Standard & Poor's calls the dividend aristocrats that have done just that over the last 40 years. So if your company is a dividend aristocrat, you know, consider weighting this model a little bit more heavily in your analysis. And the key point to this model is right here in the growth rate. As long as they can continue to grow their dividends at that rate into the future, then this is probably going to be a pretty accurate model for you. Okay, as I mentioned at the top of the hour, as with anything, there are issues that we need to be aware of. And the dividend discount model is one of those. I mentioned that, you know, not all companies even pay dividends. So if you don't have a dividend, this is going to be of no use to you. We'll have to use one of the models that we cover next week or in module 14. Some companies have unusually high dividend payout ratios. So, you know, it might be a special year. If your company has issued a special dividend that's one time in nature, that represents 60, 70, 80% of their profits, well, you need to ask yourself a serious question about whether or not they're going to be able to continue to pay that dividend in the future. And if not, this probably isn't an appropriate model. Now, there's two variants of this model, and both of those can get a little bit more complex. The cash flow approach takes into consideration not just ordinary dividends paid to common shareholders, but also net cash paid for common share repurchases. So think about this for a minute. when a company drops net income to the bottom line, they can choose to take that net income and redistribute it to shareholders as a dividend, or they can choose to take that net income and redistribute it to shareholders by buying back shares in the market. That's not really a redistribution of the cash, but it has the same effect because it's reducing the number of shares outstanding. And when you reduce the number of shares outstanding, well, you have the same pie, but now it's cut into fewer pieces, so everybody gets a bigger pie. And in effect, you've had the same thing. So we can take that cash and factor it into our dividend discount model using this cash flow approach. And then lastly, we'd subtract out any cash received from common share issuances. The balance sheet approach looks at equity. We take beginning common equity, we subtract ending common equity, and then we add back comprehensive income. And the difference between those should roughly match the cash flow approach, calculating total dividends to common shareholders. Okay, let's see, more issues in applying the dividend discount method. Know where the valuation technique performs well: stable growth companies, slow growing companies, utility companies. We already identified NextEra as a slow growth company where that would probably work well. I mentioned that the growth rate was one of the most important components if you were going to use the dividend discount model. And because it is so important, you should probably perform a sensitivity analysis along with it. And this is what a sensitivity analysis looks like. You have the discount rate, and then you forecast out varying intrinsic values given different growth rates. And these tables aren't hard to put together. They're actually pretty easy to do in Excel. So if you choose the dividend discount model as one of your valuation techniques, make sure you have one of those sensitivity analyses to go along with it. Here's some examples of some firms that do lend themselves well to dividend discount analysis. So 130 firms in the NYSE had a dividend with yields greater than 10%. You can see a list of those there. Those might be more conducive to a dividend discount analysis. These firms, on the other hand, pay no dividends whatsoever, so you'd have to look to a different technique. Discounted cash flow analysis would probably be a better method. Okay, that was pretty short and sweet. I estimated that lecture at about an hour, and we moved through pretty quickly. So that's all I intended to cover tonight, gang. I will get that exam posted this week. Any other questions that we need to cover before we adjourn for this evening?
I have a quick question.
Please.
I have been trying to access the Thomson One site, but it wouldn't work. And I used the Microsoft Edge, but then the library options will not load with the old one.
Well, keep trying. I know that can be a difficult system to access, and there's only a certain number of logins, so you have to get a little bit lucky too. Earlier in the day, I have found to work a little bit better, so maybe try it in the morning, and you'll have better luck with there just not being so much demand on the system.
Oh, okay, thank you.
I had a question about Bloomberg. That's only accessible there on campus in the finance office. Where's that located? I've actually never been there. I spent time in Black, but just have never been to the computers that have access there.
Yeah, it's in the bottom floor of the new building. My brain drew a blank. What's the new building?
I think it's 220. I just looked it up today.
Yeah, okay. Well, that wouldn't be bottom floor then. That'd be second floor.
It's the main floor. Yeah, as you walk in.
Yeah, main floor as you walk in. So you know where the Block Heritage Hall is. If you're going over to somebody help me out. What's the name of the new one?
The executive hall.
Yes, thank you. So if you're going from Heritage Hall to the Executive Hall. You're going to walk in on that floor and it's going to be immediately to your right. Just go to the corner. There's a museum over there of entrepreneurs. It's right by that museum.
Great, thanks. I know exactly where that is. I just haven't. I guess I didn't realize where the finance spot there was.
Yeah.
Hey, Vern,
Yeah.
in regards to forecasting in the project, how far out are we needing the forecast?
Go 10 years if you can. And I know that's a stretch for some of these companies, but that's going to be, you need 10 years to do a proper discounted cash flow analysis. And I want to see you do a discounted cash flow analysis. Even if you come to the conclusion that it's not the best representation of how your company should be valued, I still want to see you do it for the sake of passing this class. And then in your research report, you can say, I did a discounted cash flow analysis. I took the forecast out 10 years, but I'm not as confident in that forecast after about 3 years, which is why I chose to weight the comparable analysis much more heavily in the actual selection of my price target.
Should we do an upside downside?
That'd be terrific. Yes. When I was doing this professionally, I would always do 3. I'd do a base case, a bull case, and a bear case to understand what the upside opportunity was and what the downside opportunity was if I got it wrong.
Okay. And then last question here. In regards to like having Bloomberg, and I have like FactSet here from work, if we use data that's sourced directly from those platforms, is that acceptable, or do we need to kind of break everything down ourselves? Like, for example, I have GAAP and non-GAAP information kind of handed to me where
Yeah.
I don't have to go through and do the calculations. How do you view that?
Yeah, just cite it. Just cite the source. Say
Okay.
Bloomberg tells me, and that's an authoritative source for GAAP and non-GAAP information.
Okay.
Other
I have-
questions, guys?
I have a question about the homework.
Yes, sir.
About the last homework of chapter 11, I tried to find out the cash and cash equivalents, but that means that you have to look after the cash flow of the last years, but it doesn't have on the balance sheet. So where do you get it?
I don't know off the top of my head. Let's take that question offline. Send me a snapshot of that question specifically, and
Yes,
I'll reply individually.
It was a plug. You had to do it backwards. So once you figured out how the balance sheet worked, you could fill in that last information by itself.
yeah, plug.
Oh, okay.
Okay.
Well, take that little bit of gold that was just handed off to the class and see if that helps you out. And if not, I'll troubleshoot it with you.
Okay, thank you, sir.
Yep. Okay, gang, we're gonna adjourn then. I'm gonna say thank you for your time. I'll get that exam posted this week. I'll give everybody a shout out through Canvas. Happy Thanksgiving in advance. Stay safe, stay healthy. I'll see you back after the holiday. Thanks all.
Thanks. Have a good night.
You too.
Thanks. Take care.
Take care.